Okay, this one 2003 paper 2 question 6. This question is not really in the syllabus because it involves dissolution of partnership, which is dissolution of partnership is not really in the syllabus, but some part of it is in the syllabus. But anyway, I want to explain to you this question as well, because if you also go through and do this type of questions, you will have even a better and a deeper understanding of partnership. So it's good for you. So this question says Lim and Ng traded in a partnership for many years. Profits are shared 2/3 and 1/3 after allowing annual salary of 15,000 to Ng. No current accounts are kept. Okay, no current accounts are kept. All relevant transactions are made through partners' capital accounts. So what does the question want? The question says prepare. So you should have your question paper in front of you. Prepare partners' capital account from 1 November 2001 to 2 November 2003, bringing down the balances due to each partner on the dates when trading profits are identified. Okay, when trading profits. So list 3 advantages of partnership over limited company. So B and C are theory question. So let's solve for part A first. So part A says do capital accounts of the partners. Okay, capital accounts of the partners. So who are all the partners of the firm? Lim, Ng, and then you have Leo. Okay. 1 November 2001, Leo was admitted. Okay. So here, that means here the part A says prepare partners capital account from 1 November 2001. So here says at 31 October 2001, Lim capital was 443 and Ng was 312. So now I know how to start already. So capital account Leo, Lim and Ng. So 2001. Okay, you are supposed to start from 1 November 2001. Balance brought down. So as given in the question just now, you see the question just now says at 31 October 2001. So the balance brought down. So at 1 November 2001, Lim will be 443 and Ng will be 312. So balance brought down. Capital accounts is a credit nature account. So balance brought down will be on the credit side. Okay. So I have it. So here also I put 2001 and $sign. So now you look at the question step by step. Okay. So on 1 November 2001, so I will be reading from here onwards as we go along. Leo was admitted to the partnership, and from that date, profit and loss were shared equally after allowing Ng to keep his 15,000 salary. Leo introduced 75,000 as his capital and 21,000 for his share of goodwill. No goodwill account was raised. So I have explained to you what this means. That means no goodwill account will appear in the balance sheet. The partners making appropriate adjusting entries to their capital account. So you have your question paper in front of you, and we will go in this sequence. Okay. So the question says that Leo will introduce 75,000 as his capital. So 75,000, Leo will put in the money into the partnership. So that means the 75,000 will be debited to the partnership bank account and credited to the capital account of Leo. Okay. Okay, so now goodwill adjustment. It says in the question that Leo introduced 75,000 as his capital and 21,000 for his share of goodwill. Okay, and 21,000 for his share of goodwill. Okay, so then what is this? wait, what is this? So what is the profit sharing ratio? Okay, then now, okay, so the question, then after that, the following paragraph, profits for the year 31 October 2002. So part A of the question says, bringing down the balances due to each partner, okay, on the dates when trading profit are identified. So here trading profit was identified on 31 October 2002. So 2002, so 31 October 2002, we should bring down the balances. Okay, and then so it says profits on 31 October 2002 before any salary were 162,000. Then drawings during the year were lim. So drawings will be on the debit side, because by now you should understand debit, that means will reduce the partner's money. Okay, will reduce the partner's money in the company. So drawings will reduce the partner's money. So lim is 38,000. Leo is 38,000, is as given in the paragraph. Lim is 56 and Ng is 29. Okay. So the previous paragraph says that Ng to keep his 15,000 salary. Okay, so that means the salary for the year for Ng will be 15,000 will be given. So that means the share of profit. Okay, you see the question have actually told you that profit and loss are shared equally among all the three partners, and Ng is to keep his 15,000 salary. Okay, 15,000 salary. So that means the share of profit, the profit before the salary is 162. So after the salary will be 162 minus 15. So divide by 3. So will be 49,000 each for the share of profit. Okay, so then now the only difficult part will be the goodwill adjustment. So now we will look into. So this the goodwill adjustment. So you see, Leo is the new partner. Is the new partner in this partnership. Okay, so when Leo was admitted, it says in the question that Leo has introduced 75,000 as his capital and 21,000 for his share of goodwill. Okay, so then now we put out our ideas here. The old profit sharing ratio before Leo was admitted was Lim 2/3 and Ng 1/3. Then the new profit sharing ratio is equally, so 1/3, 1/3, 1/3. So goodwill, remember I told you, when a new partner is admitted, the goodwill, you will debit the new partner and credit the old partner. So Leo paid 21,000 for his 1/3 share of his goodwill. You see, so that means debit new partners means we are taking away the new partner's money. So in other words, so-called the partner bear the cost. We debit the new partner, that means the new partner bear the cost of the goodwill. So Leo paid 21,000 for his share of goodwill. So we debit. So because Leo have paid, so you will debit bank. Instead of debit the Leo's capital account, instead of if Leo has not paid, that means we will debit Leo's capital account, because we will reduce his balance in the capital account. But since in the question it says that Leo introduced, that means I imply that Leo paid. Okay, I interpret it as Leo paid 21,000 for a share of goodwill. So if Leo has paid, so that means you debit bank. You paid, that means it will pay into the company bank account. Okay, debit bank 21,000. So you see, you were going to debit all the new partners in the new profit sharing ratio, which is all equally. So that means you will also debit the capital Lim and debit the capital Ng. Okay, this is what we learned previously regarding goodwill. You will debit all the new partners in the new and ongoing partners in the new profit sharing ratio, and we will credit all the old partners in the old profit sharing ratio. So that means the total goodwill will be 63,000. Okay, 63,000 will be credited to the old partner in the old profit sharing ratio here. So 63,000 you times 2/3 will be 42,000, and will be 21,000. So now we will know already. From there, then we post it here. So that means we credit Lim 42,000 and 21,000. And we will debit Lim 21,000, 21,000. Leo, we won't debit him. We won't take away his capital money. You know why? Because he already paid, so we won't debit his capital account. So he already paid. We will debit to bank 21,000 because he has paid. If he has not paid, then we will reduce his capital account by debiting his capital account. So that's how it gets. So then now you close the account. I've explained to you how to close. See which side bigger. Okay, then put the same number here. Then balance carried down will be the difference. 124 minus this one, you get this one. So the question says that you will carry down the balance at the date that trading profits are identified. Trading profit, it says that trading profit for the year 31 October 2002 is as follows. Okay, it's 162. So balance carried down. So balance brought down will be 2002, 1 November will be this figure, bring it down. Okay, then now the following paragraph, it says on 1 March 2003, okay, 2003, 1 March 2003, Lim died. Okay, Lim died. Total trading profit since 1 November 2002. So since this is 31st October, since the previous account, 1 November 2002, were agreed at 92,000, and drawings during the period was 16,000 for each partner. So drawing 16,000 for each partner. So then now, okay, 16,000. In addition, Leo took over personal use of the firm motor vehicle at the book value of 13,000. So we are crediting motor vehicle because motor vehicle would reduce, and we will debit Leo because Leo took. So that means Leo indirectly took money. He did not took money, he took assets away from the company. Okay, so that will reduce his capital account in the partnership, because that will reduce his stake or his balance. Okay, the balance due to him in the partnership. Okay, so you see, in short, that debit side, this side means reduce the partner's money in the partnership, in the company. Okay, so he took away motor vehicle, so it will reduce his money in the partnership. So motor vehicle. So correspondingly, in the motor vehicle account, it will be credit. So that means you are reducing the motor vehicle in the company and reducing the partner's, Leo's money in the partnership. Okay, at its book value of 13,000. In the course of preparing the trading account, it was discovered that in the accounts for the year ended 31 October 2001, so that means in the previous account, closing stock has been understated by 18,000. Okay, 31 October 2001, that means before the start of this one. This one started 1 November 2001. It was agreed to adjust this error through the partners' capital accounts. Okay, so now you think, the question says here, in the course of preparing the trading account, it was discovered in the accounts for the year ended 31 October 2001. Closing stock has been understated. Okay, you see here balance brought down is over this side. Balance brought down is over here. Okay, before that, let's just settle the easier one first. Okay, you see the salary for is 15,000 per annum. Okay, so from 1st November 2002 to 1st March 2003, how many months? Okay, November, December, January, February, 4 months. So 4 months, his salary will be 15,000 times 4 over 12 will be 5,000. So you credit with his salary 5,000 prorated, and then the profit. Okay, the profit before partner salary is 92,000 for this period. Then you minus salary, salary 5,000, then divide by 1/3. So each one 29,000. Okay, each one 29,000. So regarding the stock, the closing stock which was understated by 18,000, we will go to working to W2 profit adjustment. Okay, we will go to working to. Okay, so now we digest step by step. It says that the question says that it is discovered that for the year ended 31 October 2001, okay, 31 October 2001, there were only 2 partners, Lim and Ng, and they share profit 2:1, 2/3 and 1/3. Okay, so closing stock was understated. So now you think whether closing stock is in support of profit or against profit. Okay, you see, if the closing stock is understated, means too little. Okay, too little. If the closing stock is too little, that means the profit is also understated by 18,000. Now you think again. If you see, so this is the example that I show you. This is the previous question. If you think again, okay, this is sales, and then you get net sales, then less cost of goods sold, opening stock at purchases, less closing stock. So now you think, if the closing stock is understated, that means the closing stock is too little. Okay, so that means the lesser the closing stock, so this is this subtotal is the cost of goods sold. The lesser the closing stock, the higher would be the cost of goods sold, and the lesser will be the profit. The gross profit will be lesser. Okay, for example, this one, this closing stock is 0. Okay, that means the cost of goods sold will be higher than this figure by 75,000. Okay, and the gross profit will be lesser than this by 75,000. Okay, so that means the lower the cost of goods sold, the higher would be the cost. The lower the closing stock, the higher would be the cost of goods sold. So that means when closing stock become lesser, the cost of goods sold will be higher, and the profit will be lesser. So that means the closing stock is in the same direction with profit. Okay, so that means like just now what I've explained. Okay, so when closing stock is understated, when closing stock is too little, the profit would be also too little. Okay, it will be in the same direction with profit. Okay, so that means the closing stock understated, that means the profit is understated, is too little. So in order to correct it, we will increase the profit. When we increase the profit will be credited. Okay, so that means the profit for the year ended 31 October 2001 should have been higher by 18,000, should have been more by 18,000. So in order to correct it, we will credit this 18,000 to the old partners, because at 31 October 2001, Leo has not come in yet, only Lim and Ng. So that means now we will correct this mistake. That means we will give this 18,000 to the old partners, Lim and Ng, in the old profit sharing ratio. Okay, so when the closing stock for year ended 31 October 2001 was understated. So you see, the closing stock for 31 October 2001 will be same as the opening stock for 1 November 2001. That means 1 November 2001 is the following financial year already lah. That means it's the opening, we call it the opening stock for the financial year ending 31 October 2002. That means it's the opening stock for the subsequent year. So that means the closing stock for the previous year was understated. It also means the opening stock for the following year is also understated. So opening stock is in the opposite direction with profit. Okay, let me show you example. The opening stock will be in the opposite direction with profit, because when the opening stock is understated, is too little. Okay, the cost of sales, cost of goods sold will be also too little. Okay, too little, and hence the gross profit will be more, will be too much. Okay, so you see, opening stock is in the opposite direction with profit. It's against profit. It's in the opposite direction with profit. So you see, the higher the opening stock, the higher would be the cost of goods sold, and the lower would be the gross profit. So based on what we understand, okay, so opening stock is understated will be, that means when the opening stock is too little, that means the profit is too much, is overstated by 18,000. Profit is overstated. It is more than what is supposed to be by 18,000. Okay, that means the profit is more than what is supposed to be for the year ended 30 October 2002. At the year ended 31 October 2002, there were 3 partners, Leo, Lim, and Ng, and they share profit equally. So since profit was overstated, it was too much, okay, more than what is supposed to be. The profit for 31 October 2002 was more than what is supposed to be. So in order to correct it, we will reduce the profit. That means we will reduce the amount, reduce the capital accounts of all these 3 partners, because previously we have credited the profit into all these 3 partners in this proportion to their capital account, but that profit was overstated, was more than what it's supposed to be. So now, in order to correct it, we will debit their capital account, 18,000 divided by 3, each one 6,000. So now we go back to the capital account. So this is how I got the figure. So from working 2, we will credit the old partners 12,000 and 6,000, and we will debit each one 6,000. Okay, then now it says goodwill. Okay, so what the question says about goodwill. Okay, it says here, Lim shares of the firm's goodwill at 1 March 2003 was valued at 60,000. It was agreed that all adjustment for goodwill would be made through the capital account. So Lim's shares of the goodwill is 60,000. So goodwill would be credited. So it says here that all adjustment for goodwill made through capital account. So goodwill will be credited to all the old partners in the old profit sharing ratio. Old profit sharing ratio for 1 March 2003. You see, now the partnership structure changes on 1 March 2003. So Lim is considered Lim, Leo, and Ng are considered all the old partners at 1 March 2003. So credited to all the old partners in the old profit sharing ratio, which is equally, and would be debited to all the new and ongoing and forward going partner at the new profit sharing ratio. So what is the new profit sharing ratio after 1 March 2003? Okay, so here, following Lim's death, Ng and Leo agree to continue in partnership from 1 March 2003, sharing profit of 60% and 40%. gives up the salary. Okay, so I have this in working tree. So look at here clearly. So it says that from 1 March 2003 onwards, okay, and Leo will share in the profit of 60% and 40%. So the credit the old partner or the goodwill in the old profit sharing ratio, okay, which is all equally. Okay, so that means all these add up together is 180,000. So now that means debit the new partner in the new, that means the ongoing, the future profit sharing ratio 60-40 in the new profit sharing ratio, debit the new partner. So that's how I get the figure here, 72 and 108. Okay, so then now we calculate the balance carried down. Okay, I show you how to so that means you total up the bigger figure, put the same number, and the difference will be the balance carried down. So balance brought down will be 2003, 1 March. So this is the balance brought down. Then it says here, after that we continue, the sum due to Lim's estate, so this is Lim, okay, was paid over on 31 May 2003, on which day introduced capital of 500,000. So has put in money to the company. So that means when put in money, the bank account would be debited. Okay, and capital account would increase because he put in money. Okay, so that will increase capital account. So Lim on 31 May 2003. So this one 31 May 2003. Lim put in the money, but put in the money 500,000, but Lim took away his money that is due to him. So the balance due to Lim is 536, and he took up all the money. So that means it will be credited to the partnership bank account. So in the partnership it will be opposite it will be on the credit side. So Lim's capital account will be debited because he took up the money from the partnership. So that means he took out the 536 from the partnership bank account. Okay, so then here they say that partnership sharing, okay, that for a period for 1 March to 31 October 2003, the firm's account show a trading profit of 170,000. So 170,000, just now it says that the profit will be shared 60-40. So 60, Leo 40. So that's how I got this figure. So 170,000. So this 60% will be 102,000 and 40% will be 68,000. Then drawings 112 and 55. 112 and 55. 112, Leo 55,000. Okay, that's how I got all this figure. Then calculate the balance carried down. Okay. On 2 November 2003, okay, 2 November 2003, the partnership was dissolved and all the assets sold for 950,000 cash. Okay. So this one balance carried down, so balance brought down will be this side. Okay. So the partnership was dissolved, so ended, and the net assets sold for 950,000 cash. Okay. On the same day, the partnership accounts was closed and the partner withdrew the amount due to them. Okay, so then how are we going to do this figure? Okay, so you see previously you should have followed all the past lessons. Capital will be equals to the net asset of the partnership. Even company also the same. Because capital means if you are the business owner or you are collectively the business owner, capital means your money in the company. Your money in the company will be equals to all the asset minus all the liability will be your money. Okay. Let's say this is my company. Okay. Or this is our company. capital means our money in the company. Our money in the company will be equals to the net asset. That means you take all the assets minus all the liability, you get the net asset. Net asset will be the business owner's money. So capital will be equal to the net asset. You see, the balance brought down Leo and the balance of the capital account is 81,000 plus 1188. So capital is 1,269,000. Okay, this 1,269,000 is also means it is the net asset. It is all the money that is in the business. Okay, which all the asset minus all the liability. That means the net asset in the business all belongs to the business owner. The business owner in this case is Leo and is the business owner of this company. So the net asset of this business, this partnership is 1,269. The question says that it is realized. It is you see they say that all the net assets sold for 950,000 cash. Okay, you see the net asset is 1,269,000 sold for 950,000. So that means it was sold for a loss of 319,000. So the loss will be divided in the profit sharing ratio, which is given in the question. 60%, Leo 40%. So 319,000 you times 60% is 191 will be, it's a loss, so it will be debited to okay, this is share of the loss, and Leo shares is 127,600. Okay, 127,600. Okay, so then what else did the question says? The question says on the same day meaning 2 November 2003, okay, the partnership accounts were closed, okay, and the partner withdrew the amount due to them. Okay, so then that means this one 2 November 2003. This one, if the partnership account is not closed, this will be supposed to be balance carried down. Okay, so but the thing is, there is no more balance that is supposed to carry down because there's no more balance that's supposed to be brought forward. Okay, so that's because the partner will settle whatever amount that is due to or from them. Okay, so then in this case, Leo, this one is balance carried down. I mean, if it's a balance carried down, so the balance brought down will be on the debit. So Leo's is supposed to be a balance brought down on the debit side if there is. So that means, in other words, Leo owed the partnership 46,600. So that's why here put your bank. That means in the bank account it will be on the debit side. That means Leo put in 46,000 of his own money into the capital account. That is because he has so-called overdrawn from the capital account of the partnership, so he must pay 46,600 into the partnership bank account. But it's the other way around. You see, if it's a balance brought down, it will be on the credit side. So that means has 996,600, still has 996,600 in the partnership. So that's why he will take from the company bank account, the partnership bank account, 996,600. So that's why then there won't be any more balance carried down. The partnership accounts is closed and settled that way. So now we have finished part A. So part B says list 3 advantages of a partnership over a limited company. So it's easy and less costly to set up, okay? Because company you have to do incorporation, which is more hassle than registering a partnership. So easy and less costly to set up. Flexibility of withdrawal of capital from the company, from the partnership. Okay, so partnership, you can withdraw your capital as long as the other partners agree. So, but in a company, as I explained before, company, you have to follow the Companies Act. Normally partners can, normally in a company, the company cannot pay back cannot pay back the share capital out of the company's funds. Okay, company cannot reduce the share capital. Okay, if you don't want your shares, you got to sell to other people. You cannot sell your shares back to the company. That's why another advantages of partnership is partnership has the flexibility of withdrawal of capital from the partnership. In the case of partnership, the partner who wants to withdraw can take back his capital from the partnership bank account as long as the other partner agree. Okay, so partnership has less administrative procedure to maintain on maintenance, drawings, admission, and withdrawal of partner. Okay, partnership has less. So that means partnership, you don't need to follow the Companies Act, which is very lengthy. Partnership Act is much shorter and simpler than Companies Act. So that's why partnership has less administrative procedures. And then partnership, also you submit only your personal tax. You don't need to submit the partnership tax. Okay, but company, you have to submit your company tax. So that's why in other words, the partnership has less administrative procedures. You are not expected to know a lot in details, but basically these are the advantages of partnership over a company. Part C, what advantages would partnership hope to gain by the use of partner current account, and which transaction would you expect to be entered in them? So part C says, what advantages would partnership hope to gain by the use of partners current account? So over here you see they say everything go through the capital account, they don't use current account. So now they are asking you, what advantages is it to have a partner's capital account and partner's current account? Okay, one of the advantages that I can think of is fixed capital can be kept fixed. Okay, so your fixed capital, that means the long-term capital will be kept in the capital account, and all the current funds like drawing, share of profits, partner's salary, all this will be kept separately in the current account. Okay, fixed. So that means one of the advantages is fixed capital can be kept fixed and separate from current amounts. Okay, current amount available for the use by partner and current amount due from the partner can be seen at a glance. So you are not mixing the fixed capital with current amounts. Current amounts means funds that are for current use that will go in and out, like partners share of profit, partner salary, interest on capital. All these are current amount that will be credited and debited yearly, and on a frequent basis. Okay, so the current amount due to or from partners can be seen at a glance. So this is another way, that another advantages that I can think of. And then better equity management. Okay, equity, that means the partner's stake in the company. That means the stake in the business is called equity. So we are separating long-term equity, long-term funds with current amount. So we are managing the equity better. So yeah, so this is better. Prevent overdrawings by partner. Yeah, we are separating current account with fixed capital account. Okay, then less complicated, hence less errors for fraud. So we don't we don't like mix everything in the capital account, so it will be less complicated. We are clearly segregating long-term funds with current funds. So if it's less complicated, it's easy to manage, and therefore less errors or fraud. This is what I can think of. Okay, so just thanks for watching. Okay.